What you see in the stock market isn't what's being built. It's what's left. The finished product sold to the public after private equity extracted the upside. And that hidden market is private equity. So, let's go under the iceberg. Welcome to Alex. Now, we're in part 1. The visible layer going to break this discussion down into 3 parts. Okay, part 1 is the visible layer. Because when most people hear the stock market, they picture their entire economy compressed into a single screen. Green and red candles, a line going up or down, breaking news, earnings season, and a daily scoreboard that tells you which companies are winning. Now, that image is real, but it's incomplete because what we call the stock market is not primarily a place where businesses change hands. It's a place where minority claims are traded. And that's a key difference. In a public market, most participants are not buying control. They are buying exposure, that they are buying a slice of a company's future cash flows priced by the market without directly touching the company itself. And that's why the stock market is a visible layer, the tip of the iceberg. The stock market is essentially a liquidity machine, a system that allows ownership stakes to be bought and sold instantly in massive volume with minimal friction. You click a button, your trade executes, and the price updates in real time. This is what makes public markets feel like the main market. It's the part you can watch live. But here's the thing. Most stock market trades do not change a company. If you buy 10 shares of Apple today, Apple doesn't receive your money. Apple doesn't hire new engineers because of your purchase. Apple doesn't build a factory because the stock went up 2%. You simply bought shares from someone else who already owned them. The stock market, as you know it, is purely based on vibes. Now, that might sound a bit ridiculous, but think about it like this. A stock price is not what a company is worth. It's what you believe the company will be worth in the future discounted into today. This is why public markets obsess over price. It's the entire product. The stock market sells one thing, price discovery. It's a global auction that never closes. And even though companies are public, the average shareholder has almost no real power. If ownership is spread across millions of people and institutions, nobody has direct control. Yes, shareholders can vote. Yes, board's sexist. But in practice, the majority of shareholders act like passengers that they are holding tickets, not steering wheels. This is why the visible market behaves the way it does. It's hypersensitive. It reacts to headlines. It gets emotional. It moves on narratives. And that's what creates the chaos, millions of participants constantly updating their beliefs and the price swinging as a result. So above the waterline, what you're watching isn't business happening. It's opinions colliding. The stock market is the most visible financial system on Earth precisely because it's the easiest to see. It produces a public signal every second. But don't confuse visibility with importance because the deeper ownership shifts, the ones where somebody actually buys a company and decides what it becomes, rarely happen on your screen. That's why the stock market, as most people know it, is a tip of the iceberg, a loud liquid public layer where the shares trade hands while the real structure moves happen underneath. On to part 2, the hidden part 2, the hidden layer. Now, if the stock market is a part above the waterline where prices move in public, then private equity is part underneath, the place where companies change hands without anyone seeing it happen. And this is a key shift. In public markets, the main thing that changes is price. In private equity, the main thing that changes is ownership, control, decision-making. Private equity is not a type of stock. Private equity is a system where specialized firms raise large pools of capital, then use that capital to buy businesses privately, restructure them, and sell them later at a profit. But instead of millions of retail traders clicking buy and sell, private equity runs on a much smaller number of massive players: pension funds, sovereign wealth funds, insurance companies, university endowments, and ultra-wealthy families. And it's structured much like a machine. Here's the structure in plain terms. A private equity firm creates a fund. That firm is called the general partner or GP. They are the managers, the decision-makers, the people who pick the deals. Then they raise money from investors called limited partners or LPs. Now else include public pension funds like from teachers and firefighters, sovereign wealth funds. Think countries parking oil money, insurance companies, endowments like Harvard-type pools of capital and family offices. And these investors commit capital for a long time, usually around 7 to 10 years, sometimes longer. And that's why private equity is private in a functional sense. There isn't a public market where you can just dump your position tomorrow. Once the fund has money committed, the GP starts buying companies. But here's what makes private equity fundamentally different from stocks. Private equity isn't buy some shares. It buys their entire company, or at least a majority, and that means they can replace the CEO, change pricing strategy, sell divisions, acquire competitors, change cost structure, refinance a company's debt, or force distributions of cash. And this is why private equity returns behave differently than public market returns. The IT takes a company off the public stage into the backroom and runs a controlled transformation. And they don't have, for one thing, an exit. Now, exits usually come in three forms. First, sell the company to a strategic buyer, another corporation. Second, sell to another private equity firm. And third, take it public where it becomes part of stock market again. So, above the waterline, you see a ticker symbol. Below the waterline, you see the real transaction. Someone bought the whole company, turned it into a product, and later sold it to public. And before you go deep on how all of this works, I wanted to quickly mention the Alex app, because you know the kind of content we put out here for free on YouTube. So just imagine the quality we keep behind the paywall. On the inside, we've launched an exclusive network of vetted entrepreneurs, millionaires, and even billionaires. It's called the Alex Network, and it's a place where you can share ideas, ask for support, receive advice from people who've already done what you're trying to do. You might even find someone to team up with in there. All successful people know that much of the power and influence comes from being part of a strong network. And not everybody has that locally, so we fixed that. Join us inside by downloading today at alux.com/app. And if you scan this QR code on screen, you'll secure 25% off your annual membership. That cost is tax deductible, by the way, and we even have an expert collection all about private equity. All right. With that said, let's get back to business and explain the specifics of how the hidden stock market really works. Part 3. The engine room 3 is the engine room. So, now that you understand what private equity is, we can finally talk about the part nobody sees, because a hidden stock market doesn't look like a stock market. Above the waterline in the public stock market, people trade pieces of companies. They buy shares, they sell shares, and prices move based on expectations, fear, hype, and whatever the crowd feels today. Like I said, it's based on vibes. It's mostly a market of perception. Below the waterline, private equity is not trading opinions. It's trading control. When private equity buys a company, it doesn't buy some shares. It buys a company itself, usually all of it, or at least more than half, so it can make the decisions. That's the whole point. A public investor can own shares for 10 years and still have no real influence. A private equity owner can change the CEO within a week. And once private equity owns a company, it starts the engine that makes this world work. The engine is called an LBO. Now, LBO stands for leverage buyout. And that sounds kind of complicated, but it's actually pretty simple. It means you buy a company using two types of money, your money and borrowed money. Private equity rarely pays the full price in cash. Instead, it uses debt like a lever. Now, here's how that works in real life. Let's say there's a coffee shop business, for example's sake. It's worth $1 million. A private equity firm buys it like this. The IT puts down $300,000 from its fund and it borrows $700,000 from a bank. Now it controls a $1 million company, even though it didn't pay $1 million. It only put down $300K. So far, this already amplifies returns because a small amount of equity controls a larger asset. But now comes the part that makes private equity different from normal investing. Because private equity does not pay back that $700K debt from its own pocket. The coffee shop does. Once the deal is done, the debt sits on the company. And every year, the business produces cash. That cash is used to pay the debt down. And when the debt goes down, the owner's equity goes up. Not because the business became magically better, but because the company now owes less money. If this still feels confusing, think about it like an apartment. You buy a $100,000 apartment with a mortgage. If you owe the bank $80,000, then you only really own $20,000 that apartment. But over time, you pay the mortgage down to $30,000. Now you own $70,000 of that, the same apartment, same walls, same location. The only difference is how much belongs to the bank. Private equity works the exact same way. So, back to our coffee shop example. In year one, the business is worth $1 million. It's got $700K in debt. So, the equity is $300 because equity is simply value minus debt. Now, over time, that business makes money and pays the debt down. In year 5, let's say the business is still worth $1 million. It didn't even have to grow. It just had to remain stable and profitable. But now the debt is down to $400K. So the equity becomes $600K. The coffee shop didn't need to double revenue. It simply converted cash flow into debt reduction. And debt reduction increases equity. This is the first engine. But it's not the only engine because after private equity buys a company, it does two things at the same time. First of all, it improves how the business runs. And second of all, it improves how the business is financed because the business is made stronger by operating improvements. The first thing private equity looks at is how the company actually works day to day. They ask questions like where is the money being wasted? Which products are low margin and should be removed? Which customers pay late or cause problems? Are prices too low compared to competitors? And is a company bloated with inefficiency? Sometimes they also buy competitors to merge them, so the company becomes bigger and more dominant. All of this has one goal to increase stable cash flow because stable cash flow is a fuel that pays down debt and increases the value of the business. But the returns are amplified through financial structure. And this is part nobody sees because it happens on paper. Private equity looks at the company and asks, what is the best capital structure for this business? That's a fancy way of saying, how much debt should it have? What kind of debt? At what interest rate? And with what maturity? Because private equity firms refinance companies all the time that if they can reduce interest rates, cash flow improves instantly. If they can extend the maturity of the loan, risk goes down. And if the business becomes more stable, they can often borrow on better terms. Private equity improves returns through multiple forces at the same time. Debt goes down, which increases equity. Cash flow improves through operations. Financing improves through structure. And eventually a sale converts everything into real cash. And that last part is the most important. Now the obvious question is if the coffee shop is printing money every year, why not keep it forever? And the answer is very simple. Keeping the company is owning an asset. Selling it is completing the deal. And private equity is a deal business, not an ownership business. A private equity fund is judged on what it can produce in a fixed time window, usually 7 to 10 years. That's the product. So the job isn't just to buy a good business. The job is to buy it, improve it, and exit it. So investors get their money back plus profit. And once the private equity firms sell the coffee shop for $1 million, the math looks like this. It sells a company for $1 million. It pays off the remaining $400K debt, and it keeps $600,000. And now that private equity firm has doubled its initial investment, turning $300K into $600K. This is the real engine under that iceberg because what you see in the stock market, that's usually the final version. It's what's left after private equity finished the work. After the company was bought, reshaped, loaded with structure, and prepared for an exit. Above the waterline, you see the ticker and the chart. Below the waterline is where the company was actually turned into an investment. All right, Alexa, thanks for spending some time with us. That's a wrap for today. We'll see you back here next time. Until then, take care, my friend.